Well, good afternoon, everyone, and thank you for joining us for our annual year-end tax and planning opportunities webinar. My name is Bob Ingram. I'm a financial planner here at Center for Financial Planning, and I'm joined by my colleague, Michael Brocavich. Michael is a partner and also certified financial planning practitioner at the center. And on behalf of our entire center team of 30 professionals, we appreciate your continued confidence and trust as we strive to improve lives through financial planning done right. And in serving clients as a comprehensive financial planning firm, we recognize that financial decisions are not made in a vacuum, but are often very much interrelated. And while taxes alone should not dominate every decision, we understand that tax considerations do impact, many financial decisions that you have and planning strategies. So not only for yourselves, but also for other generations of your family. So our goal is to keep on your radar opportunities that may help save money and maximize your resources, not just in 2024, but over the years and even decades to come. So many of the opportunities, of course, we'll talk about today will be tax related in that regard. But just one quick note before we get started. We're not going to be able to take questions during today's session. We certainly encourage that you write down any questions or thoughts that you have or ideas that you pick up from today's session and send them to your planner or really to either to Michael or myself. And we'll have some ways to be able to contact us and be able to connect with the center as we wrap up today. So with that, what are we going to cover today? Well, there's things that you probably want to do before the end of the year. We kind of call these our year-end checklist or our year-end to-dos. Most people have things that they should really be thinking about each and every year. We're also going to look at really some tax law changes that really have happened. I mean, it's seemingly every year for the last 4, 5, 6 years, we've had some kind of changes to tax laws and different opportunities. So we're going to touch on particularly the Secure Act in 2.0, some things that have been out there for a couple of years and some opportunities and changes for 2024 into 2025. And then there's also the Tax Cuts and Jobs Act. We know from 2017, a lot of tax laws, tax brackets, and other things have changed. And as of now, those tax law changes are set to end as of 2025 if Congress doesn't take any action to extend them or to renew them or change them in some way. So what would happen? They could sunset back to the different tax rules of 2017. So we'll talk a little bit about that, our views on that, and then how might that impact tax planning and just general financial planning strategies and opportunities, not only this year, next year, but in the coming years. And then finally, we'll wrap up with some additional resources and some next steps to take as you finish up your 2024 and start a great new year in 2025. So with that, Michael, when we look at kind of the year-end to-dos, things you could be thinking of, kind of where do we start?
Yeah, thank you, Bob, and thank you for all of those out there that are joining us today. On the top of a lot of folks' minds when they're thinking about what we need to do before the end of the year is taking those pesky required minimum distributions, so these RMDs. We've had the rules change on us a little bit over the years. We've had the age at which people have to start to take the required minimum distributions change. So historically, that age had been at 70 and a half, but with the Secure Act, we've seen that age move. So it had moved to 72, but now for folks that were born after 1951, between 1951 and 59, that RMD age is now 73. And for folks that were born in 1960 or older, you don't have to take an RMD now until age 75. But it is important that we take these required distributions. If we do forget, there is an IRS penalty for not taking that RMD. The IRS could impose a fine of up to 25% of your RMD for not taking it. They'll give you a little bit of leeway if you get that corrected right away, maybe only a 10%. But you don't ever want to unnecessarily get these penalties. Because taking your RMD is pretty simple. You just need to be able to take those distributions out of your retirement accounts before the end of the year. For those of you that have turned 73 this year, so in 2024, and this is your first year of taking an RMD, you actually get a little bit of extra time. So it's not just December 31st. You have to satisfy that. You actually get till April 1st of next year. But we recommend looking at what your distributions are and making sure that you get those done before the end of the year. Now, some folks out there that you may have inherited a retirement account from a loved one, whether it's an IRA, 401k. But if you have inherited a 401k and you inherited that from someone that was a non-spouse, historically in the past, we have been able to stretch those IRAs over your lifetime. Well, with changes through the Secure Act that we talked about in the past, the stretch over your lifetime is no longer available. So for most people, what you're going to have to do is if you inherit a retirement account, you're going to have that distributed over 10 years. So sometime over that 10 years, you need to make sure that that account has been fully distributed to you. Now, there are some exceptions. There are some people out there that can still stretch over their lifetime. For example, a surviving spouse, if you inherit your spouse's IRA, you're going to have some different rules on what you're able to do with that. Also, minor children have the ability to stretch a retirement account if they were to inherit it over their lifetime. Disabled individuals, chronically ill individuals, and also beneficiaries that are not more than 10 years younger. So if you're within 10 years of age of the person that you inherited this account from, you may be able to stretch it out over your lifetime rather than having to liquidate it over 10 years.
And Michael, it's interesting that's we see that sometimes in cases, let's say, where someone might have a sibling as a beneficiary as opposed to kids, or that are within 10 years of each other, 10 years age-wise with each other. Even in some cases, ex-spouses. Technically, an ex-spouse does not qualify as a surviving spouse, but may have an ex-spouse as a beneficiary, and if that's a possibility within 10 years of age, that gives that an opportunity. So some of those exceptions are a little bit more rare, but we do see them, particularly for the not more than 10 years younger.
Yeah, absolutely. There's a lot of folks out there that inherited retirement accounts from siblings, that are not more than 10 years. So, it is an option out there that will be available to a lot of people, but again, it's going to be limited and not available to everyone.
Now, an interesting question that really has come up, and we've talked about the last couple of years, but now you're under this 10-year rule. You have to liquidate it all by the 10th year. But what about the annual RMDs? Is there still an annual RMD required for the folks that are under that 10-year rule?
Yeah, so when Secure Act created this 10-year rule, the original rule stated that if the person that you inherited the account from was at the age of RMD and were actively taking RMDs, then when you inherit that retirement account, you would also be required to take a distribution every year. Now, we know you have to distribute it within 10 years, but the IRS was saying, yes, we know that it needs to be distributed within 10 years, but we want to make sure that you're taking a distribution every year on those 10 years. Now, because of these rule changes and they've moved the goalposts a little bit on people recently, so what they've done is they've actually waived that required distribution. So if you have inherited an IRA and that person that you inherited from was of age RMD, and you haven't been taking your distributions out of that inherited IRA, that's okay. The IRS has actually waived this requirement for the last couple of years, and they've even waived it for 2024. However, they've signaled to us that this will be the last year that they waive that. So starting in 25, you will need to take those required minimum distributions out of that inherited IRA.
And I think that really starts to get into more of a planning discussion is around, well, okay, let's say you don't have to, or you haven't yet taken any distributions the last couple of years if you inherited, since 2020. Should you though? I mean, there's a good, are there times
Yeah.
where you actually should still plan to try to take some funds out as opposed to keep deferring that until really the last minute?
Yeah, and that's a really good point, Bob. I mean, everybody's circumstance is going to be different. So it's important that you sit with, your professionals that help you out, a financial planner, maybe even a tax advisor, to come up with a plan that works best for you. but it may make sense to take take distributions out even if you don't have to. For example, if you're in a year where you're in a lower tax bracket, so maybe it would make sense to try and get this money out now while you're in a low tax bracket, knowing that it needs to be liquidated in 10 years. If you have any type of cash need for vacations, home improvements, this would be an account that you might want to take some money out of, a little extra, in order to be able to afford those things. Also, if you've inherited a fairly large retirement account and you know that you have to distribute that over 10 years and it has to be gone by the 10th year, you may want to take distributions every year to try and even out the tax burden on that. Because there potentially you could save taxes by taking a little bit out of it every year to liquidate it rather than just waiting until the 10th year and taking it all at one time. So there's definitely some strategies there to look at and be able to do some planning with your advisors. But Bob, we know that everybody out there doesn't need to take an RMD. We got a lot of folks out there that are actually still saving for retirement and putting money into retirement plans. What are some things that those folks need to be thinking about going into 2025?
Yeah, for the savers out there, certainly if you're contributing to retirement accounts, retirement plans, whether it be 401k, 403b, et cetera, even your IRAs, if you have the opportunity to try to increase your savings, if you set a target goal, if you're working towards a certain saving percentage or a dollar value and you haven't yet hit that goal, maybe it's up to the maximum contribution limit for the year. And you still have a little bit of time. If you're able to increase your payroll deduction or your payroll contribution percentage, some plans allow you to actually defer 100% of your income on a paycheck. You could do that in kind of what we call power saving. We've talked about it in the past, but it's just a way of being able to get, a little bit more money, kind of those extra year-end savings. You can't go and write a check from your savings bank account, put it into the 401k plan, let's say. But instead, what you could do is use the last couple of paychecks or maybe the last remaining payroll that you have, put as much as you can into the plan. And instead of getting the paycheck to live on, that's where you could use your savings to live on for the month that you would otherwise, plan to save from the savings account. So ways to do that. Obviously, just to note the different limits for this year for both pre age 50 folks, as well as the catch-up contributions, the extra $7,500. So, for someone age 50 and over, you can contribute, let's say 401k, 403b, et cetera, up to 30,500, simple IRA up to 19,500. And of course, the traditional Roth IRAs as a possibility, 7,000 for folks under 50 and 8,000, for the 50 and above. So, and just to note, the nice thing about the IRAs is we were able to still contribute to IRAs up to the tax filing deadline next year. So gives you a chance to see if you're able to be eligible for, let's say, a tax deductible contribution to a traditional IRA, or even be income eligible for a Roth contribution. You can kind of see where your income will end up at the end of this year and allow you to make those contributions. Looking at 2025, you also want to set up your planning for what percentage to contribute in 2025. And we have the new contribution limits. Not a big change there, for their folks that are under age 50 to 23,500. So we increased by 500. The actual regular catch-up for over age 50 stays the same. It's unchanged. So another 7,500 that you can add to the plan if you're hitting age 50 and above in 2025. But you'll see there's a third column here. We've added a third column which says age 60 to 63. Now that's a little strange, right? Well, the Secure Act 2.0, one of the provisions, set an extra kind of a interesting, super special contribution for those age 60, 61, 62, and 63. And that will start to be available in 2025. So next year, there's actually some additional dollars. So for someone that is at least age 60 to 63, the total catch-up contribution for 401k, 403b, and 457, for example, is up to $11,250. So a few $1,000s extra beyond what someone over age 50 can contribute as a catch-up. And then the simple IRA, same thing. 5,250 is the total extra catch-up contribution for the folks in those years. So an interesting way to maybe get a little bit of extra savings, going if you're, 60 to 63.
Yeah, that's
Now,
great, Bob. A way to allow people to save a little bit more at later in life as they're getting closer to retirement. So that's
yeah,
a nice addition for from the Secure Act.
yeah. Well, talking about the, employer plans and benefits and things, there are also some things to make sure to take advantage of from maybe a medical side, and other benefits. Michael, what should people be on the lookout for there?
Yeah, as people are going through open enrollment right now, you're selecting your medical plans for next year. And a lot of people have options where they're selecting whether they want to start contributing to a flexible spending account or a health savings account. So both of these accounts are great for helping you pay for medical expenses. Both accounts allow you to put in pre-tax money. And then that money can come out and be used for qualified medical expenses. And when that money does come out, it comes out 100% tax-free. So if your employer does allow you to contribute to these, it's always advantageous for you to do so. So flexible spending account is generally the most common that people have out there. Flexible spending accounts allow you to add money into that pre-tax. But the stipulation with a flexible spending account, it's a use it or lose it account. So you have to use it up before the end of the year. So folks out there that have money in a flexible spending account that haven't used it yet, you want to look and see, all right, are there expenses that I've incurred that I can reimburse myself for? Or are there things that I need that I could use the rest of this money up for before the end of the year? For example, if you need some new eyeglasses or if you need contacts, something of that nature. A flexible spending account can be used for those items as well. Now, a health savings account, the advantage there is it's not a use it or lose it account. So again, it allows you to put in pre-tax money, but that money is allowed to be able to accumulate if you don't use it within that tax year. And so you can carry over your balance to years and years, and you can grow that account to be a nice medical account for you to be able to use down the road. This is an account you can even take with you into retirement if it has a balance. A lot of providers will allow you to invest that money into mutual funds within the program. So it's very advantageous that if you are able to contribute to an HSA, that you do so. Not everyone is eligible. You need to have a high deductible health insurance plan. So high deductible means at least $1,600 out there for single. And for families out there, the plan needs to be at least $3,200. Take a look at your open enrollment this year and you have these opportunities. Make sure that you're putting some money towards these accounts. In addition to that, there are also our Medicare folks out there that are in open enrollment. That open enrollment that started October 15th and it goes through December 7th. For this open enrollment, this is the opportunity for you that those of you that are already on Medicare to be able to make changes to your existing plans if you so choose. And the premiums will be going up for Medicare Part B and Part D. Part B premiums will be going up to $185 per month, where Part D drug coverage will be going up to $46 per month. Just want to make folks aware out there that you need to be conscious of your income in retirement in order to not kind of fall off what we call that income cliff, where if you have taxable income that's over $212,000, you could have to pay a premium on your Medicare premium. So, for example, folks in the next bracket that are above $212,000 have an additional $74 a month that they would need to pay for Part B, and an additional about $1,370 that you would need to pay for Part D. So you want to be conscious of your income in retirement and do some planning again with your planner as well as your tax advisor. If you do find yourself in a situation where you had kind of a one-time deal where you had higher income and you're worried that your premiums may go up, there is an appeal process that you can do through Medicare. Specifically if you had some sort of life-changing event that were to cause that additional income. Um,
And Michael, it's a great point. And retirement is a great example of one of those life-changing events. So let's say someone's income, making a significant income in their last year of working or last years of working, and will have a big drop for the first couple of years of retirement. That's a changing event where you could appeal and say, no, the income going forward is not going to be at the same level as last year when I was working. And
Yeah, and that's a
so,
good point. Yeah, that's a very good point, Bob, because really it takes 2 years for Medicare to really kind of catch up to where your income is at. And so for folks that have retired, now all of a sudden they're in retirement at a lower income, the Medicare's not really going to know that. They're just looking at what your income was from a couple of years ago, and you were probably working at that time, making, the highest income you've ever made. So you can appeal to Medicare in order to make sure that you're not paying those extra premiums. Now, Bob, we've kind of gone through the stuff that people need to make sure that they're doing before the end of the year. But are there any changes to tax laws that we should be thinking about or focus on?
well, we kind of thinking about that, the good old Secure Act 2.0 we mentioned. There were a couple provisions. I mean, you kind of mentioned some in terms of the change of the required minimum distribution ages under Secure Act 1.0 and then the 2.0, as well as some of the savings amounts. So this year, as we talked about before, the change in catch-up contributions, adding that extra catch-up contribution for folks age 60, 61, 62, and 63 becomes effective in 2025, as we said. And generally, the amount's going to be 150% of what this year's 2024 regular catch-up amount. So, one and a half as much as 700 or 7,500. The other provision that we're kind of looking out for that we've been following is one that says that catch-up contributions must go to a Roth plan, a Roth 401k 403b. In other words, it would have to go to the after tax, be taxed first, and then go into the plan onto a Roth side. Now, there's a few interesting things about that. For folks that make above a certain income threshold, and the target had been 445,000. So employer is making dollars income over 145,000. Those catch-up contributions would have to go to the Roth. There's a lot of logistical complications that we've certainly seen. Number one, so far plans have not been required to even have a Roth side of a retirement account. They can just have the pre-tax 401k or 403b. So what does that mean? Do they have to change that in order to accommodate having Roth catch-up contributions? So with all of these logistical issues, it's been delayed. We're still seeing it delayed out until at least 2026, but it will make a difference in terms of planning as to where you save and what the tax implications are of those additional savings if this does continue and goes into effect in 2026. There are also a couple other exceptions to the early withdrawal penalty that are kind of starting to kind of trickle through. Financial emergencies effective this year. For a financial emergency, you can actually draw, a small amount, but $1,000 from a retirement plan. If you're under age 59 and a half, you avoid that penalty. For domestic abuse victims, can draw out up to 10,000 effectively this year for different needs, and it would not have to pay that early withdrawal penalty. And the nice thing about that is if you're able to pay that back, it can be done over a few years, over 3 years, to actually put those dollars back into the plan. And then there's long-term care costs that could be used or offset through a withdrawal that is exempt from that 10% early withdrawal penalty, 2,500, and that's generally going to be effective in the next couple of years. So a few things just to be kind of thinking about, and that's out there for the Secure Act. Now, the other sort of elephant in the room has been the Tax Cuts and Jobs Act. So we know that, as we said, 2017 kind of reshaped a lot of the tax rates, tax brackets, did things like almost double the standard deduction, took away the personal exemption. So, a lot of different factors there. So if nothing is done, the way the law is written is after 2025, it's set to go back to 2017 amounts. So this is just an example, kind of a hypothetical projection of what the tax rates could look like in 2026, adjusted for inflation at those brackets. You can kind of see back, from the 2017 levels, there was no 12%, the first couple of brackets, 12%, 22, 24, those didn't exist. It was 10%, 15%, 25, 28, and so on. So in some brackets, you could say, well, so the income might go up, taxes might go up at those similar levels of income. The crossovers to the brackets are also, you can see a little bit differently. Now, we also had a change in terms of a big year in terms of the presidential election and also, national election for Congress. So how does this change our view, or does it change our view of what happens to the sunsetting? And the reality is we don't have a crystal ball, but the Tax Cuts and Jobs Act did come under the first Trump administration in 2017 to go into effect in 2018. Now that the Republican-controlled Congress and administration, we really would think, based on some of the things that were campaigned on and some of the discussions of things, is it more likely that we see some kind of an extension, or at least rates that are similar to today, if not in some cases, maybe talk of even some lower rates? I mean, I think that's probably realistic when all things considered. It doesn't necessarily mean that we won't see rates change in the future, but the likelihood is over the next year, could we see these extend? So what does that mean, Michael, in terms of our ways that we think about strategy and different tax planning? A lot of what we've talked about is, in case those tax cuts go back and we could see increases in taxes, there was a lot of good reason to maybe accelerate income, to take advantage of the lower rates now, and we only had another year to do that. Does this sort of change our view on that?
Yeah, Bob, that's a really good question. And although we do believe that these tax cuts are going to be extended, it still gives us a great opportunity to accelerate income and get income out at lower tax brackets and continue to take advantage of these. I mean, if these tax cuts are extended, it just gives us a longer runway to be able to utilize these strategies. And the reality is it could be possibly that some administration down the road decides to increase taxes back up. So it likely won't happen over the next 4 years, but then after that, it could be an opportunity for another administration that may feel like they want to raise taxes just due to the deficit that we have and the growing national debt. It may make sense at that time to raise taxes. So we want to make sure that we identify strategies in order to continue to take money out for people at these lower tax rates.
So I guess one key thing, of course, is from an investment perspective, different things we can do investment wise. We've talked about things over the years, different ways to position portfolios. How should we think about that going forward?
Yeah, one great thing to start to think about is looking at your after-tax portfolio. So these are the investments that you have that are not in a 401k IRA, so your retirement plans, but this is more your trust account, your brokerage accounts, joint accounts that you have out there. And what you want to be able to do is really take advantage of the tax laws into realizing capital gains and making sure that you're paying the least amount of tax as possible when you're realizing these capital gains. If we look at this chart here below, you'll see the comparison of the capital gains tax rate compared to just the ordinary income tax rate. And so the one thing I'd like to point out is folks that are in that 12% tax bracket, if you look, you don't have to pay taxes on capital gains. It's a 0% federal tax rate on capital gains. So if people are able to utilize and take advantage of gains during those brackets, that would be very advantageous. But let's talk about some other strategies to look at while you're investing in after-tax accounts in order to help you save some taxes. First of all is, asset location. So if you have investments in taxable accounts, but you also have investments in IRAs, one thing to take a look at is, are those investments tax efficient or not tax efficient? So what do I mean? For example, let's say you have an investment that pays a lot of income to you every single year. That may be an investment that you would want to put in a tax deferred account like an IRA, so that when that income is paid, you're not having to pay tax on it every single year, and it just gets deferred. Where investments that are tax efficient, For example, like a municipal bond that pays us interest that's tax-free, you want to make sure that that investment is in your taxable brokerage account or trust account invested in there so you can fully realize the tax-free interest advantage. Another thing to start to look at is what we call tax loss harvesting. So it's a little bit of counterintuitive. It means selling an investment at a loss. Now, I know our investment rules are always to, sell high and buy low. For this particular strategy, what you're doing is you're selling an investment at a loss to realize that investment loss in that tax year, and then immediately taking that money and buying an equivalent investment. So unfortunately, you can't buy the exact same investment. The IRS has a 30-day wash rule where they want you to be out of that investment for 30 days. But you could sell one investment and immediately buy something that's fairly equivalent and keep your money invested while realizing that tax loss. If you don't have capital gains in that particular year to offset those tax losses, that's okay. You could use up to $3,000 of those losses against ordinary income. And also, you're able to bank those losses to offset against future capital gains. So why would we might have some future capital gains? Well, another strategy would be gain harvesting. Again, a little bit of a counterintuitive strategy where I'm selling something to purposely realize the taxable gain. In this instance, you may want to do that because one, let's say that you've been harvesting losses over the last few years, and you want to try and trim down a highly appreciated asset that you own. You could sell that asset and then have those gains offset against losses that you've harvested either that year or in the past. Also, if we remember our tax brackets, if you're in that 12% tax bracket in retirement, you don't have to pay capital gains taxes on those gains that you realize. So in respect of keeping your income in that 12% bracket, it may be advantageous to harvest some gains, realize them, not pay taxes on those gains, and really be able to make your portfolio a little bit more tax efficient in the process. Bob, we've talked about a lot of strategies of being able to move assets around in your portfolio in order to help make it more tax efficient. One of the big things out there that we help clients with, though, in order to reduce their taxable income is giving money away charitably. What are some strategies we have out there for people to be able to give charitably in a tax efficient way?
Yeah, it really is a very a big important strategy, and it's so important to many clients, and especially at this time of year as well. Toward the year end, we do a lot of gifting around, the holiday times, and there's really a number of different ways that you can gift. Really, there's from giving cash, literally writing a check or making a cash donation, to donating securities, to even pulling funds directly from a retirement account like an IRA account. So the benefits can vary. We'll talk about a few of these specifically, but it really, of course, depends on everybody's unique situation, their tax rate, and kind of the expected tax situation in future years. So let's talk a little bit about the difference of donating property versus a cash. So a couple example comparisons here, but bottom line is, if you donate cash, you're just making a gift that can be deductible. Of course, to get a tax deduction, it's an itemized deduction. Keep that in mind. It's an itemized deduction because we'll talk more about that. So it's one of the categories. There are certain percentages, a maximum that you can get a deduction for relative to your income each year, depending on what kind of property you're giving. The other, so instead of cash, let's say you were to donate securities. Now, why would you do that? Donating appreciated stock or shares of mutual funds you might own in a regular taxable brokerage account, regular investment account. So we're not talking about retirement accounts or IRAs, but regular taxable accounts. When you give that property, you're essentially doing a couple of things. One, especially if it's highly appreciated, you're removing the capital gain that's unrealized, that's there building up. You're literally being able to say, well, I don't have to worry about that capital gain. You're giving that property. If you were to sell the security in order to have the cash to make an otherwise cash donation, well, that would be a capital gain. You'd have to realize it. So could be a little bit of a lost amount of dollars there just to cover the taxes on the sale. So this example is just one where someone that's in the highest tax bracket potentially, they have a stock that's worth 20,000 or cost 20,000, worth 50,000 now. They want to donate it. So they sell the 50,000. They may have taxes at the highest brackets, of upwards of 23.8% for capital gains and net investment income. So they're
Okay.
going to lose that amount. And so their benefit of only giving is maybe 40, just over 42, under 43,000. And so if they are able to deduct that against income, maybe that's a tax savings of just under 16,000.
Okay. Yeah, that's great, Bob.
Yeah.
Now, a lot of folks, they may want to donate some of their appreciated securities, but they don't want to give it all to one charity. Is there maybe a strategy that could be helpful there?
Yeah, exactly. So the difference in benefit of the extra benefits of gifting the stock is you don't have that loss of taxes. You actually gain, you can contribute and allow for the higher deduction potential. But if you want to give and have a large deduction in one particular year, but maybe you want to separate out the gifts to the different charities on a different timeline, a donor advised fund is a great way to kind of bunch or lump some charitable giving to one year. So the way this works is it's almost like a small family foundation, a little simplified. You set up a fund, a custodian has that, and it's set up as its own charitable organization, qualified charity. So when you make contributions to the fund that you'll set up with a custodian, that in and of itself is a potentially qualified charitable gift. Once it goes to the donor advised fund, you can then request grants be made out to the charities of your choice. Now, of course, they have to be technically approved because you've gifted an irrevocable gift to the donor advised fund. So as long as the charities are qualified charities as well, usually that's not a problem. It works really, really well to make those grants, and you can make them at different timelines. So somebody that's usually gifting maybe a couple thousand a year, and they say, well, I'm not getting the benefit. I want to make a large charitable gift this year to try to reduce some income, maybe to offset a large income year. But I don't necessarily want to give all of that to the charities just this one year and then not give for the next few. So they can get the funds in the donor advised fund and then make grants a little bit along the way, maybe a little bit every year. So it's when you're ready, you have that ability and control to decide when to request those grants. So it can be pretty
Okay.
effective.
Yeah, that sounds like a really great strategy, be able to give to charity. But what about if I don't have any appreciated securities in a taxable account, but I still want to be able to give charitably, throughout my retirement? Is there a strategy for me?
Yes, and we talk about this quite often with qualified charitable distributions. So what this is, of course, is gifting directly from your traditional IRA account. And those funds would literally go to the charity. And what does that do? That offers an excluded amount of distribution. So what does that mean? When you make those distributions directly to the charity, you don't have to claim them as a withdrawal. Normally, when you withdraw funds from your pre-tax IRA, you would claim that income on your tax return. So it's pre-tax, you're paying the taxes. This is excluded. So your qualified distributions are excluded. You don't have to claim them. Now, you do have to be age 70 and a half. And so for folks that are 70 and a half or older, this is certainly available. This works particularly well if you're used to or plan to take the standard deduction. If we still see that, going back to the Tax Cuts and Jobs Act, if we still see the standard deduction at the high level, which this year for folks that are over age 65, it's over $30,000 of a standard deduction that you'd have to exceed before you itemize. So if you're taking that standard deduction, at least you're getting that extra tax benefit of the donation because it's coming right out of the income from the IRA. You're able to lower the IRA balance. You're able to use those dollars at low tax rates, right? But you're able to take that out and exclude the income. Now, there's a limit per person per year, 105,000. Again, the Secure Act 2.0 actually made this adjusting for inflation. So for years it was 100,000. And so this year it increased to 105,000. and it will go up with inflation. Next year, in 2025, it's projected to be 108,000.
All right. So, Bob, if I was someone out there that had a required minimum distribution on my IRA, and I didn't want to pay tax on it, could I use this strategy to satisfy that distribution and avoid tax?
Absolutely. That's a great point, and it can be a great way to do that. So rather than giving from your, from checking account or savings and just paying out of pocket, give right from the IRA to the charity, and that counts. That counts as your RMD. So it can be a great way to satisfy the RMD and get that nice excluded amount that you don't have to pay tax on.
It's really good, Bob, because we love tax-free. The least amount that we can pay on taxes on distributions is always advantageous to us. Which brings me up to our next topic, talking about Roth conversions. So how can we get more money into these tax-free type of buckets? So real quick, a lot of you are familiar, traditional IRAs. That's where all your pre-tax retirement money goes. So money you've been saving in 401ks and other retirement plans, a lot of times you'll roll those into traditional IRAs. So that's your pre-tax savings. Another account that exists out there is a Roth IRA. So Roth is your after-tax savings that is accumulating tax deferred, and then that comes out in retirement as 100% tax-free. So it's always advantageous to us to try and get as much money as we can into these Roth IRA accounts. Now, we do have income restrictions that prevent people from just making contributions to the Roths all the time. So a strategy that we talk to a lot of people about is Roth conversions. And so that's moving money from a retirement account into a Roth account, paying the taxes on it. And why would we want to do that? Well, if you feel like you're in a lower tax bracket today, then you may be in the future. So let's look at kind of a simplified example of this. So you have these buckets represent the different tax brackets that folks are in when you're taking income in retirement. So someone that takes a distribution, you're going to have part of that distribution taxed at 10%, part of it taxed at 12%. And if it leaks over into this 22% bracket, well, you're going to have part of that distribution taxed at 22%. Now, if you feel like you're in a tax bracket today that's going to be lower than in the future, for example, people in the beginning of retirement might find themselves in a low tax bracket now, but once Social Security starts and required minimum distributions have to be taken, you could end up being in a much higher tax bracket later on. So what we talk about is kind of filling up those tax brackets when you can. So in this particular example, if we know that an individual is eventually, when they take RMDs, going to be in the 24 or even maybe 32% bracket, why not fill up this 22% bracket, take money out of your IRA, pay the taxes at it on 22%, move it into your Roth IRA, because we know that eventually you're going to have to take required distributions, and those would be at 24% if your income was higher. So it allows people to save a little bit more on taxes by filling up these buckets. It's also advantageous, maybe if you're in that 12% bracket, making sure that that bucket is filled up all the way to the top as well. So why do we want to do Roth conversions? Well, we want to do it when our income is low, because as we said, take advantage of a lower tax bracket. We want to make sure that we save money on future withdrawals of these retirement funds. So conversions will help not only you, but also your heirs with saving money on taxes. So when you convert this money into Roth, you personally don't have to take a required distribution out of that money. And so you could let that money continue to accumulate. Also, if your heirs inherit that account, they can distribute that money 100% tax-free as well.
Michael, that's a really good point, especially as we had talked about those inherited IRAs now with that 10-year rule, provided that still is in the tax law. If you are inheriting a large balance in a pre-tax, that could be a big tax bill and a hit for your heirs. Whereas, yes, a Roth IRA, they would still have to withdraw the funds in 10 years under that current law, but it's at least tax-free when they have to take that out within 10 years, right?
That's right. Yep. So having these different strategies is always good. You never know what's going to come up when you need to during retirement. Having these tax efficient or tax-free buckets are always great for the kind of those one-off expenses you have in retirement where you need some extra income, but you really don't want to put yourself into a higher bracket. Now, not everybody's able to do just these straight Roth conversions. A lot of times it's only advantageous if you feel like you're in a lower tax bracket than you will be. But there might be people out there that are in a higher tax bracket today or earning higher income and want to be able to get money into Roths. So right now, the rules, you have income restrictions on being able to just directly contribute to a Roth. But there are a couple, I guess you can call them loopholes around being able to do this. One is called the backdoor Roth IRA. Simply what you're doing here, if you're an individual that currently doesn't have any money in a traditional IRA, so all your current savings are either in after-tax accounts or in work retirement plans, what you could do is just make a non-deductible contribution to an IRA and then in the same tax year immediately convert it to a Roth. This allows you to get money into the Roth without actually causing a taxable event. So this is called a backdoor Roth IRA. Another way that you could do this, which we refer to as kind of a mega version of this, is if your employer retirement plan, like a 401k plan, allows you to make after-tax contributions there. So we're not just talking about the Roth 401k side of your account, because in this strategy, we'd likely have you max out the pre-tax bucket in your 401k, but then you are allowed to put money in some plans after tax. And so being able to put that in there after tax, and then when you do retirement, or when you do retire, you can pull that money out and roll it into a Roth IRA. Now, you can only roll your contributions into a Roth IRA where your earnings would have to go into a pre-tax bucket. But still, it's a way for higher income folks to start to build up those Roth IRA assets for you. But Bob, I know that you were talking about some tax changes that are coming up with Secure Act, and are there any other ways that people can get money into Roths, thanks to the Secure Act?
Yeah, so just a couple things to kind of keep on the radar is that employer retirement plan matching contributions can allow it allows for employers to make matching contributions to a Roth. Now they're not required to, so it's going to be up to the employer to offer that. And again, there's some logistics that may have to be set up. Again, not every employer plan has a Roth plan, whether 401k, 403b, et cetera. Simple and SEP IRAs can actually accept Roth contributions. Kind of an interesting way. You can set up a Roth Simple or a Roth SEP. Now, the other way to kind of think of it is you could use a conversion, so this may be a little bit, not a drastic change. You could always contribute to normal SEP and simple IRAs and then convert those dollars. But having just a Roth option is a possibility. Again, every custodian is kind of treating this a little bit differently, so this might be slow for adoption. But the other is the 529 plan. If you have 529 plan dollars and you get to the point where you may not need them to fund your children or grandchildren's college, the Secure Act has allowed for rollovers. So you could actually roll over a certain amount from your 529 plan balance to a Roth IRA. Now there's some annual differences. There's a total lifetime maximum of 35,000. You can only roll over per year the amount of the normal annual contribution. And the other thing to consider is this is for federal taxes. It's available to qualified expense, so you don't have to pay taxes on the funds rolling over to the Roth. Now, not all states have adopted that rule in terms of state taxes. So you've got to look at that. Michigan right now is a state, as an example, that is not considering this a qualified education expense. So there may be some state taxes on the earnings in the 529 plan balance if you were to do this. So important to obviously think through this from a total tax perspective, not just federal, but also state taxes as well.
Yeah, those are some great provisions to be able to get some more money. I'm really excited about the 529 college plan over to Roth IRA. I think that will allow a lot of young people to get some money into the Roth IRA if they still have 529 money available out there. So that's a really nice change from the Secure Act. Um, with I know that we were talking about giving charitably, but is it possible, could you maybe combine a couple of these strategies where I'm giving to charity to reduce my income, which maybe allows me to convert some money into a Roth?
Yeah, the idea of taking a few of these different strategies and combining them can be powerful. So yeah, let's look at that example from a charitable giving standpoint, and we'll use the donor advised fund along with it as an example. So let's say a couple, let's say Joe and Susan, they're in their 60s. They've just recently retired. They were making 200,000, and they think that their income needs, this year probably going to be somewhere around 120,000. So that kind of gives them an opportunity, if they've been used to having income of 200, where they could, take some additional income. But they don't necessarily want to have to go into high tax brackets to do that. And they're charitable. They give, 5,000 a year to charity. Well, what could they do? Well, we talked about the idea of lumping multiple years' gifts into a single tax year. So, let's say they contributed 50,000, 10 years worth of their normal annual giving, and they put it into a donor advised fund. Well, there, depending on how they do that, whether it's a cash donation or security, appreciated securities, there could be a percentage limit on the income. But what does that also allow them to do? They could get a deduction. They could move those dollars and then make grants like they are used to doing, 5,000 a year. They could still do that by requesting the grants from the donor advised fund. But it could allow them to also take a Roth conversion in the amount of the deduction that they're going to get. So we figure out what the amount of the amount that they'll actually be reducing their income. They could add a Roth conversion if that made sense to, again, take some funds out of the pre-tax IRA at a low cost, possibly no cost, get that growing in the Roth IRA. Alternatively, using some of the harvesting, maybe they could actually take some gains or if they have some ordinary income that could help offset some of the ordinary income, that they could lower their actual ordinary income amount. So different ways to be able to combine these strategies in years where it makes sense, whether it's a gap year of lower income, oftentimes before Social Security income starts, certainly before required minimum distributions, are required in 73 or in the future at 75. Having a kind of looking at this from a multifaceted way, we say financial decisions, right? They're not just made in a vacuum. This combines a few different kinds of financial decisions, both looking at things now, but also looking at, well, what could be changing in the future, and how do you maybe hedge some of that? So trying to be proactive as much as possible and building that into a plan, makes it as efficient as they can for for their tax planning and income planning.
Yeah, what a great strategy, Bob, being able to give some to charity, but also give a little bit of something back to yourself, where you're able to move taxable assets into tax-free assets, for yourself later in retirement and potentially later on for your heirs.
Yeah. So I know we've covered an awful lot. We talked about a lot of different strategies, some items to kind of do right away, the next month here, as we kind of go through the end of December. We want to make sure, if you do have questions, please reach out to your planners. You have those conversations. I'm sure you're already having many of those conversations that have had these kinds of conversations. But also, if you do have a question and you're maybe first introduced to the center through this, we certainly would welcome any questions that you have. Feel free to reach out to Michael and myself. Here's our emails. You'll notice the QR codes on the right-hand side as ways to contact us. For those folks that would like to maybe have a little bit more of an in-depth conversation to take a look at some of your questions, we'll offer and be happy to schedule a complimentary 30 to 60-minute meeting or call with you. Happy to do that. And through that, we'll be able to, again, answer the questions, talk about some of your planning, or give you a second opinion on just general planning strategies that you're working on now. Are there any gaps? Are there any roadblocks or speed bumps that you may not see coming? And we found that that can be a really great way to do that. And we're happy to offer that. We also have resources like our tax and planning guide, our monthly newsletter that we send out. If you're interested in subscribing or getting those, please go to centerfinplan.com to the contact, QR code obviously to the right. Our Money Center blog. We do a lot of writing on all sorts of financial planning topics, and tax planning is certainly one of those. So go to the blog on the site. And then also our events. Stay tuned. Keep up to date with our upcoming events and future webinars as we get into 2025 through centerfinplan.com under the events page. So with that, we want to thank you for your time today and investing in yourself in this education. We hope that you found it very helpful, and it could take some next steps in having those conversations. And wishing everybody a wonderful rest of the year, wonderful holiday season, and a great start and a happy new year to 2025.
Thank you, everyone.